Yeah. Um, Okay, the floor is yours.
Thank you. I know you guys were waiting for another presentation on Colombia and the agri-food sector in Colombia, so here I am. Uh, this is a work from myself, Lorenzo Nalin, economist at FIO, and my friend and colleague Giuliano Toshiro Yajima. And we also address stock flow consistent input-output modeling for the agri-food sector in Colombia. And the reason for this, the motivation that brings us here. Sorry. Okay. Is the fact that we want, at least our idea is that foresight analysis, so looking at longer trends in agri-food system, could be done with a different methodology apart from the usual CG modeling stuff that within most of institutions looking at agri-food systems are employed. So I don't have to explain to you that the reason why we use stock flow modeling and why this methodology is useful to look at subsectorial characteristics, interdependencies from a balanced perspective and so on. But we wanted to develop a model, quite simple model, I would say, but to show at least within the department where I work, which is the foresight analysis department at FIO, how the interplay of direct and indirect drivers of agricultural system can be measured and can be explored using this methodology. In particular, I work in a team that takes into account and that takes care of the future of food and agriculture flagship publication. And of course, there we use CG modeling. So the idea here is to show that for those type of long-term analysis, we can actually apply our methodology, our stock flow consistent methodology. And we look at some historical trends, as most of you have done and presented in these days. We look at historical trends and we try to model them as a weak signal, so challenges for the future, and look at how these weak signals can be addressed and what are the results using the stock flow consistent methodology. We focus on Colombia, basically because we already, Giuliano and myself, done some work on Colombia. So this part of research is a personal line of research that I have with Giuliano. So it's not FIO that requires to do this research. Neither was Colombia to formally ask to perform this research. So we started from something that we already have without any institutional demand for this work. But we think that it's interesting to address the case of Colombia agri-food sector from the macro agri-food sector perspective due to three main science facts or weak signals, as we call it. And the first one is that, no surprise, Colombia is a commodity-dependent countries that operates with a current account deficit. Historically, I don't know if you can see it, but in the last 30 years, there has been most of the time current account deficit, reflecting the fact, as you know, that you export raw materials, you have to import capital goods, you have to import technologies, so you most of the time operate with current account deficit, finance through a foreign exchange debt. But this macro-wide characteristic is not only seen at the national-wide level, but also within that sector. First of all, when we look at the trade balance of a share of gross production of agriculture, you see that Colombia started 30 years ago with the supply, so exporting more than importing, but is down up. will be close to zero. So basically, that surplus is vanishing. And also, if you look at the agrifood trade structure by primary product or processed product for household and for industry, you see a well-known path that is you import, you export primary activity, primary products, either for household consumption or for industry, and you import more processed, higher value food, and the same is happening for industry. More close to zero, but you don't have, you have a type of industry that is mainly focused on primary export and production rather than higher value added ingredient. It's also reflected in the fact that if you look at the inputs, Colombia is a net importer of fertilizer per cropland. So vital input for production is produced abroad, which is strange for a country that is a oil producer, as generally fertilizer is a byproduct, could be pretty easily developed when you are rich in oil resources. So here is also confirmed the fact that mostly the sector is related to primary production of higher value added. And apart from that, we see a scenario, we see a current trajectory where government has taken a low and progressively lesser role in investing in agri-food system. Here, I want to the agricultural orientation index for government expenditure, which is calculated by FAO, and it's basically a measure of how much the government is investing in the sector given the size of the sector. And as you can see, not only compare peers in the region or same level of income, the Colombian government is investing less in agri-food system, but it also since the end of the commodity boom with lower availability of fiscal budget is investing. Is that basically the capital share is really low, meaning that most of the activities are labor intensive done by small medium farmers. So having all these setting in mind, we try to model this macro structure picture within a stock flow consistent model. And a little bit of history of this model that we present. And by the way, this is a preliminary exercise, but it's truly preliminary, as most of you have said that there were preliminary jobs and then you presented fantastic work. Yeah, I have less slides, less time to spend on the presentation, and I'm looking for feedbacks actually, because the idea is to present this work within FAO and try to reach out to a CGE community and try to create some interest in other practitioners. So, but anyway, we started when we were working at Ecological as a consultant with a more macro financial model for Colombia. And then we did some work for the Ministry of Energy for the transition. And now we take the work we did previously, although we changed quite few things, and then we try to look at the value chain. So, but beside the historical trajectory of the model, I guess what is more interesting is how we structure the model, which again, I think we're not trying to expand the literature, having something completely new or having innovation within the literature, but we are adapting something that already exists, and we try to talk with a community that is not familiarized with this model. So the model again is common model with just 6 institutional sector, firms, household banks, governments, central bank, the rest of the world. From the input-output model, from the input-output matrices, we aggregate as much as we can services, manufacturing, and extractive activities, and we disaggregate as much as we can the agrifood system with 6, if I'm not wrong, agricultural production subsector, basically producing commodities, agricultural commodities, and also agricultural manufacturing subsectors that are those which are the property and manufacturing. So, and then, yeah, we have, sorry about we have 7 financial assets. Again, it was mentioned before, it's not a highly financialized country, Colombia, so we have the government issuing debt in foreign and national currency. We have the central bank buying foreign bonds from the rest of the world as a reserves. We have firms demanding loans and receiving them from the financial sector. The financial sector, when it's not possible to finance loans with deposits, requires demand foreign loans to the rest of the world. So pretty easy structure, I would say, apart from maybe many sectors for the agriculture, for the agri-food sector. So we use discrete time, and by using input-output table from OECD database and combining them with the national county statistics from DAN, we obtain a baseline for the period of 1995 to 2023. And then we use mostly standardized methodology to come up with public debt and flow funds numbers. We estimated the trade equation using ECM, and the remaining one were estimated using OLS equations, OLS techniques, implicit interest rate calculated using interest, payments, flows, and sectoral balance sheet that we constructed. And the behavior equation, I know I was coming after Sebastian Mandacanto, so I just mentioned without reporting any equation that we use the work based on stock flow input-output model. So basically investment adjust to a target. You need disposable income to determine consumption, and disposable income is also affected by net wealth from balance sheet and financial asset, and so on. So that's a typical stock flow input-output model with no major variation from their work, just adapted to a large number, I would say, of agri-food industries. So scenario analysis are not so many. So you already at the end of the presentation mostly. But how we construct scenario analysis is following what basically try to do within our publication. So we look at the status quo about what is going on in the economy, and we try, qualitative speaking, to imagine a future that is different and that goes where we would like to. And then also we think what can be wrong in the future that we don't want to experience. And here, so the status quo, the more of the same scenario, is pretty intuitive and linked to the style aspect that I presented before. So current account deficit, reliance on external borrowing, agri-food systems highly privatized, highly specialized in primary commodities, and no great investment from public sector, and also low level of capital. In the towards sustainability scenario, that is where we try to be a little more, I would say, maybe optimistic, maybe try to imagine what we need. We think that a possible way to structure this scenario is to start thinking about the agri-food as an engine of growth and as an engine of structural change, at least within the system, within the sector. We imagine higher and higher spending from the public sector, and spending from the public sector targeted toward agricultural manufacturing, because he has many leakages in the upper and lower value chain, and also because as many spillovers, at least the literature says so, in terms of technological advancement for the agri-food sector. Think, for example, about water resource management, about infrastructure for water management, about digitalization of the agri-food system, traceability system that needs a geospatial referencing system. So it seems a primary commodity-oriented sector, but actually can have certain technological spillover. So we imagine a scenario where the government invests in these manufacturing and agricultural activities, and also generates a more animal spirit mode. So we also think that there is a crowding effect for private investment. And all in all, this combination of private and public investment creates a more competitive product in the external sector. So there is an improvement in the performance of exports, and there is lower dependence of inputs. And finally, when we think about this future that we want, or we imagine this optimistic wave of the future, we also think that there is, I don't know if it's a national development bank, but there is at least a decoupling from external borrowing, because most of the time you have great ideas, then you finance them with external borrowing. And external shocks, as you know, can change all your public strategy. The rest to the bottom, I don't know into many details, it's just the opposite. So a world where you depend more on external inputs, a world where Colombia is not competitive anymore with its agri-food products, and a world where there is basically no investment from the public sector, and a focus mainly on primary products. So quantitatively speaking, what all this fantasy scenario means, we start, so the baseline scenario are calculated data. It is share of public debt, those historical data, the average historical data. And we start thinking what would change quantitatively in this over sustainability good scenario. And the first thing is that increase not by that much, but by half percentage point the growth rate of real public expenditure. And then we arbitrarily decide that 30% by 2050, 30% of this greater spending is oriented towards those six manufacturing, agri-food manufacturing sectors. And this animal spirits environment is given by component of the investment function for the manufacturing agri-food industries, increasing 6%. This create better competitiveness in the external market, so we raise a little bit more than 10% the export income elasticity. We decrease the dependence from external inputs. And then when was the year where you issued less debt in foreign currency, we decided, okay, let's assume that this year we can finance 70% of the debt that we will issue in domestic currency. The rest of the bottom is basically the baseline, but it's competitive, so decrease elasticity, and imports are more penetrating the economy, so we raise the import system. The results, so this was the first run of the model, I would say, so maybe we have time to digest a little bit of this, but the first, so you can see, but the first hint we have is that by investing in agri-food manufacturing activity, we can partially alleviate the external constraint. Of course, by settings of these experiments, this is an expansionary policy, this is an expansionary package. So you're not surprised, I guess, that the growth rate of GDP is higher in this towards sustainability scenario, but it's substantially higher. The gap in the other scenarios is increasing, and reaching 1% by the simulated time frame of 2050. And again, we simulated an improvement in elasticity parameters in the positive scenario. So again, no surprise for the trade balance goods, but it's at least interesting to quantify these different between risk about and towards economic scenario of 3% of GDP, which is a decent result, I would say. First, by investing just in 6 agricultural manufacturing sector, you don't have surpluses. By improving their income of exports, you don't have surpluses, but at least it can mitigate somehow the external balance. And also in terms of current economy, you don't have the expected decrease in the current account continuing. By the way, the validation of our result has been done looking at the series E level. The series, of course, in year-over-year change, and also for the forecast for the baseline scenario, we look at the main projection from IMF, from World Bank, and from national institution, and we are aligned more or less, say more than less, with their estimation. Clearly having a more dynamic environment, also external environment, means that more consumption, so more sales for firms and less financial needs for firms, which actually can avoid the issuance of approximately 10% of debt of loans by 2050. But this positive environment in terms of lower budget constraint and lower debt is also recorded, is also experienced by the private sector, which enjoys higher taxes, thus has lower by the public sector budget, and then issues less foreign debt. The result of foreign currencies debt is influenced by construction by this cap of 30% that we imagine for this future that we would like. But still, the results are pretty significant, 20%, 25% difference between worst and best case scenarios. When we look specifically at the agri-food sector, a sector preliminary result is that without no intervention, so the leading things as they are, the agri-food system may become actually a sort of sustainability in the sense that there is an increase, for example, of loans required by the agri-food sector. And in the worst case scenario, there is an increase in imports and a decrease, for example, of fixed capital formation. It's interesting here the difference between the two scenarios is 2% of GDP, which for a sector, specifically for a sector, I would say is pretty significant. And when we look at the composition now, just of both the agri-food manufacturing sector, so here we look at the sector that we're benefiting from the shock. We see that we have three more dynamic sector. One is coffee manufacturing. Not surprising, what was mentioned before, the sector is highly export-oriented, is an highly export-oriented sector. But interesting is that together with the manufacturing of coffee, we have also a significant growth in processing of meat, fish, pterodaktils, and molluscs, and also the production of cereal derivatives and animal feed production, which are two sectors that are strongly linked. And these are by law, because there are trade restrictions, export given different standards and so on. So these sectors are not export oriented. So these positive responses are coming from a higher domestic demand, and these positive responses are positive indeed for food security. So you're producing more food. Given the presentation from before, we're not considering environmental issues. So I know it's a limitation. I will mention that before, but again, I have to be careful in selling the methodology within FIO, especially if I want to treat environmental things linked to agriculture. So the strategy here is to go step by step and try to involve more environmental consideration with the teams that are in charge of this. So for now, we're looking at balance of pay restriction and growth and this type of dynamics, which actually is my role at FIO within my team. And finally, this is the last slide. It's important. You can't see it, but it's important. There are sector-specific differences among the 7 manufacturing sectors. So, for example, we mentioned that coffee would be benefiting from this type of shocks and would be benefiting from exports more than imports. Is the blue light line. While when we talk about meat and fish processing, the positive effect is created more by import substitution rather than export growth, but the real effect is. And when we look at capital, both coffee and meat are already relatively capital intensive compared to other sectors. But when we look at capital compared to the baseline, the winner of the sector that benefits the most is the crop production. So I think that this truly preliminary exercise, at least hopefully, will explain to my colleagues that we can perform sectoral and subsectoral analysis indeed using the software input output methodology. And these subsectoral insights complete a broader picture for macro-financial linkages with agri-food development. And as mentioned, the model is just the beginning. So again, we recognize that the environment is not treated. Also, maybe we can, having more energy requirements. So there are room to improve this preliminary work, but still, we can see from the status facts and from the modeling that agri-food-led structural change could be a strategy that Colombia could implement, at least to improve, not solve, but improve the external balance position that is deteriorating, at least after COVID. So that's all.
Sorry, but Fernando Martin had to go. So who is discussing?
Yeah. I'm going to probably listen.
So yeah, it will be short, and I will leave the floor for maybe they have questions, feedback. So first, I think I really like the approach of starting to add like much